Hey, this is Garrett Goggin with Golden Portfolio. Today, Brett Heath, CEO of Metalla Royalties, joins us today. Thank you, Brett, for joining us.
Thanks, Garrett. Thanks for having me.
You can find Metalla. They're publicly traded New York Stock Exchange, MTA. I used to work on the floor of the New York Stock Exchange. That's how I got started in the business. And then, Brett, like I've known you for a while. We used to go on mine trips together, right?
Way back when.
We went on a couple smaller silver companies, I believe. But you saw the light before me, right? Because you were looking to get involved with the gold sector, and you figured out that the best way to get involved in the market is through royalties, right?
Yeah, that's right. And originally, I did come from the buy side. And when we were doing all this research and we were evaluating the mining equities, from the large all the way down to the small, we quickly realized that, look, these royalties are the way to do this. You need to own this stuff at the asset level because you can own it through the cycles. You can take a long-term view and you can build for the future. And so, in the kind of around 2013, 2014, I started out in the royalty business. And in 2016, started Metalla, which is the company that you mentioned that we're discussing today.
Yeah, excellent. It took me a few years to come around to that viewpoint also, and that's why I started the Golden Portfolio, right? Because as you know, royalties, they have fixed costs. Gold goes higher, you get all the upside, you don't get the cost inflation. You get free exploration upside, right? You pay for your contract up front. You get all the exploration of the minor ads year after year after year. It's you can run a royalty with a few people, right? You get a Geo, you get a finance guy, you get a CEO, someone to count the money. How many employees does Metalla have?
Metalla has six full-time and one part-time employee.
Yeah, so those profits, on a per employee basis are the highest in the industry compared to the miners. Miners have, hundreds of people, the royalties of three, four, or five. Who structures your deals? Do you do all the valuation structuring yourself?
Yeah, well, we approach transactions. Each transaction that we approach is usually a bit different than what is kind of typical for the royalty and streaming sector. And the reason is our strategy over the last 6 or 7 years was really focused on buying royalties that already existed. So we're buying royalties that already existed. The purpose of that was because we wanted to give our shareholders exposure to the highest quality assets in the best jurisdictions with the best geology and the best operators. And in order to do that, we had to buy royalties that already existed because these big companies would never, they would never encumber their properties, especially for a small dollar amount. And so that was kind of our strategy that we executed. We did 32 different transactions over about 8 years. The largest of that was the merger with Nova Royalty, which happened in 23. And now we have 102 assets. And the whole purpose of that kind of when you look at the royalty business, they're really kind of different levels. There's the junior, then the mid-tier, and then the major. And the strategy kind of to get to each one is a bit different as you grow your business. And, I feel that now Metalla is basically, from an asset profile perspective, at the very least, we've kind of made it to with 102 different royalties and a very significant amount of growth coming, the cash flow profile will catch up to the asset profile, we think, within the next few years. But we feel that, we finally kind of made it to that level where we'll be able to become a mid-tier type of company and we'll have more access to capital, a lower cost of capital that allows us to continue to grow. But and some of those deals in the future, as we continue to grow the business and scale, may look probably a lot different than what some of the ones in the past have looked like. But in the past, again, like we needed to have an edge. We needed to have a way to grow our business that allowed us to competitively kind of outperform the rest of our competition at that time. And that's what we did to kind of get us to that next stage.
Yeah, I see it in the royalty industry, all the time. And since you started a few years ago, you're looking for royalties to just basically, cover your management salaries, so you can grow on a non-dilutive basis. All your cash flow is funded, but now you're moving to a point where you're putting money in the bank, so you can go after larger deals.
Yeah, that's correct. And I mean, when we came into starting this business, and the view and basically the way we wanted to execute, and the what we kind of tell our investors is, look, like, I believe it takes about 10 years to build a really solid royalty portfolio. And the reason is because mines take a long time to get built. Even the best operators that are the most established and obviously strong balance sheets and so forth, it just takes a very, very long time. And if you want exposure to really good assets, then you oftentimes need to kind of take a step back and buy these things at a little bit earlier stages, because once they are much more well known, once they're established, once they're in production, then the valuations of these assets are significantly higher, which makes smaller companies have a much more difficult time, just because their cost of capital is so much higher than call it the majors or even the larger mid tiers. And so, that was the way that we saw it. And so having all of these assets that we bought that were in development 3, 4, 5, 6, 7 years ago, what we see today is just this very significant growth curve in front of us. Now, it's a growth curve that is bought and paid for. And it's a growth curve that we were able to benefit from kind of that later stage of growth, and being able to kind of capitalize on a lot of this production that's going to start coming out of the ground at $2,700 per ounce, instead of coming out of the ground at $1,200, $1,300, $1,400 an ounce. Because if your subscriber base is familiar with the mining industry, the average gold mine, may have a mine life around 10 years, 12 years or so. And if it was all in production in the very beginning, and if it was a good asset, you probably sold a lot of that as that cash flow was coming in. And then now we're in a position where you have to really redeploy it. And redeploying fresh capital in an environment that we are today is much different than where it was when gold was trading at like 15, 16, 17, 1800, where we felt that there were some really just great opportunities to lock in some future growth. And so we can talk through some of those assets, if you think, but yeah, we're really excited about this.
Same thing in the royalty industry. It takes a long time for a mine to be developed, and if you're paying for in production assets, you're overpaying. You're not going to generate a tremendous amount of profits from that deal. So what you were looking for were for interesting projects that have a little ways to production. And now we're moving into that phase where the mines have matured, they're moving into production, and your Geo Production's growing from 2,500 ounces in 24 to it's going to double or triple by 2026, right?
Yeah, that's right. So our guidance for 2024 is right around 25 to 3,500 gold equivalent ounces. We're kind of tracking towards the lower end of that this year. But 2025 is going to be a very kind of significant year for the business, and going forward each year, as the portfolio continues to mature, we're going to see very significant jumps in Geo Production Growth. So we haven't given out our formal guidance yet for 2025, but when you look at kind of our existing portfolio of producing assets, plus the additional ones that will likely come on, that will add a very significant amount of production, which is Tocantinzinho. This is G Mining's new asset down in Brazil, just came on production this year. We have La Guitarra, which is Sierra Madre's silver mine, that just came in production this year. We have Amalgamated Kirkland, which is Agnico Eagle, one of Agnico Eagle's asset, up in the Kirkland Lake camp. This is scheduled to come onto production in Q4 of this year, so it's another new royalty. And then as we get into 2025, first half of 2025, we're expecting our royalty on the Endeavor mine, which is in Cobar. This is operated by a company called Polymetals Resources, and that's going to be a very significant contributor. So kind of looking at where that may lead us in 25, we're probably going to be expecting somewhere around 5,000 gold equivalent ounces. So a very significant jump from the probably closer to kind of 2,500 to 3,000 geos for 24. And as we move into 26, there are additional assets that are going to be coming online that we believe will get us to kind of 7,000 to 8,000 range of gold equivalent production in 27. Probably something closer to the 9 to 10,000 gold equivalent production. And all of that growth leads into this window of 2028 to 2030, where we have some very significant assets that we don't know exactly when they're going to come online, but it's looking highly probable that they will. And they're very, very significant, very long-term assets that we think could take our growth from kind of 2028. By 2030, we could see a kind of almost a double from there.
Big copper.
Big copper assets. And the beauty of it is the royalty business is all about playing the cycles. And when you look at our portfolio compared to our peers, we have, amongst the mid-tiers and the juniors, not including the majors, but amongst the mid-tiers and the juniors, we have our top 10 assets have the highest reserve life of all of the other companies. So 20 years on average reserve life for our top 10 assets. So as we get into kind of the latter part of this decade, which I think lines up perfectly well for this commodity cycle. If you look at kind of where we're at in this commodity cycle, we had basically a consolidation from was like 2011 or so up through basically earlier this year before gold finally broke out. So I think, when you look at these cycles, like you probably have another, at least kind of 1999 through 2007 type of move, maybe an additional kind of decade type move. But at the very least, like it looks like this cycle will line up to gold will continue to outperform through the end of this decade, and it'll happen at a time as our portfolio continues to grow from a production standpoint. And all of that growth is bought and paid for.
No doubt. And even if the gold price stays here and the copper price stays here, it's ridiculously accretive. Regarding, accretive, when I say accretive, I'm talking about profits, being able to spend $100 and get $1,000 back. TZ, right? You spent $9 million for that, 0.75% NSR, right?
Yeah, it's a 0.75% GVR, and we bought that for about $9 million. It was a few years back. And when you look at the cash flow profile today, it's probably going to end up being call it around 4 million in free cash in 25. We'll probably get a bit here in 24 as well as we get production payments for Q3 and Q4. But you're looking at an asset that's probably about something in between 2 and 3 year payback type of time frame, and an asset that's got a 10-year reserve likely will get extended significantly, big land package. So some of the returns, when you look at some of these assets that we bought, are starting to be very attractive. And as these things come online, obviously, that's going to directly impact our shareholders.
Right. 10-year times 4 mil, 40 mil based off the current gold price. It's probably going to extend longer. It's straight profits that create shareholder value. That's why I like the royalties so much, and so do you. One of the things that's interesting about Metalla is that I look at the royalties on a free cash flow to EV basis, and Metalla pops out because it trades at a very high valuation. Now, that's not necessarily a bad thing because it's in good company. A lot of the companies that trade at really high cash flow multiples, the market doesn't understand what's going on, or the average investor doesn't understand the upside. And the difference between Metalla and the other royalties is that NAV basis and those big copper assets that you need to add into your valuation. And these are massive copper projects, right?
Some of the biggest in the world. and they're being developed by some of the biggest operators. So the two that we think will likely come into production, kind of the earliest, will be Copper World, which is Hub Bay's asset in Arizona, and Taca Taca, which is First Quantum's asset in Argentina. These are monster copper gold projects, and we think that there is a high probability that they are fully permitted potentially before the end of this year. That's what the companies are guiding towards. And if they are fully permitted before the end of this year, we're probably looking at another 12 to 18 months prior to them making a construction decision or a final investment decision to build those types of assets. And once that's there, with their minority partners locked in and the financing locked in, then you're looking at, I mean, each project's a little bit different, but typically you're looking at about a 3-year time frame, which puts us right into that kind of 2028 to 2030 window. But once these assets are built, these big copper porphyries, I mean, it's got a 30-year reserve, but when we looked historically at these assets and the average life of mine that they typically go, it's about 74 years. So when you do that research, you're like, okay, well, that's so far out. But again, like in the royalty business, it's those cycles, and we're expensive from a cash flow. Coming back to your first point, we're expensive from a cash flow to EV perspective today. But that's only because a lot of that cash flow is just starting to come online. So when you kind of run those numbers and see what we're valued kind of a year out, 2 years out, 3 years out, we're going to start to become much more kind of in line probably with our peers and attractive. At the same time, when you look at us from a NAV perspective, we're one of the best opportunities out there, and it's because the bulk of our portfolio value is still kind of in that development stage, or if it is coming into production, it's just starting to produce. So you still have 10, 15, 20, some of our assets have 30, 40 plus year reserves. So, as the portfolio matures and the cash flow profile matures, our costs are going to basically stay relatively the same. We have kind of what we need, I believe, to scale this company to being a multi-billion-dollar business, and I think that's where we'll be able to take it.
Speak to me about Copper World and Taca Taca. Are these streams, gold streams?
Royalties. So these are royalties. These are uncapped royalties that go in perpetuity. And that is very, very rare to get in this business, because typically what you've seen in the past on these really big assets are these big streams that are done. You see, Wheaton Precious has a bunch of them. Franco's done some of these. And these streams today are much more structured as almost kind of debt with a little bit of metal price upside. There's big drop downs, there's certain production milestones. And so, that tail or that optionality, if you will, which is something that I believe is very misunderstood within the royalty and streaming sector today. I think it's something that was really kind of the core part of the early companies like Royal and Franco, which were kind of the first ones that were out there. And I think those companies and some of the bigger ones still understand kind of how to price and really be able to acquire optionality. But it's that optionality that is so key in this business.
It's free upside for you guys. Speak to me. What prices do you use in your price deck to model your NSRs?
Yeah, so I mean, typically kind of consensus long-term pricing. Currently, we have a handful of banks that cover us. Two that recently launched on us was National Bank Financial and Canaccord. Were two recent launches, and we also are covered by Bank of Montreal, BMO, and Ventum Capital Markets and Haywood. So
But
we've got
their price decks 5 years out have gold at like $2,200 an ounce, right?
That's right. And actually 22, the consensus long-term price is at 20 kind of 2200, and that's actually still fairly low. And the banks always are slow to move that long-term price.
What's the copper price? 5 years from now for the bank estimates?
The long-term copper price, I still believe is sub or right around 4. It's either slightly below or slightly above
Yeah.
$4 a pound. But to give your subscribers some perspective, every $100 increase in gold and every 50-cent increase in copper to our portfolio adds about 50 million US of NAV. So at a currently, sitting around, didn't check what we were at today, but around, call it a little over 300 million US market cap today. Every $100 and 50 cents copper moves up, that adds about 50 million of additional torque. And when you look at kind of where gold is, well, it's already $300, $400, $500 below where it's trading at today, meaning that the analyst consensus values have a huge level that they need to increase, which they probably will increase as gold kind of consolidates and kind of stays where it is. So today, these valuations that you see are based on numbers that are well below where we're trading today. And so it gives a really great opportunity, for investors that understand this view that, look, we are in the beginning of a bull market in gold and silver. We were in basically a bear market for, the better part of kind of 12, 13 years. And we're at the beginning of another one. And the whole entire equity sector, doesn't believe it. And it's been one of the most stealth kind of bull markets in gold. Gold equities are just starting to kind of move today. If you look at Metallis chart, we've broken out of about a little over a year consolidation since we announced the Nova acquisition. We turned over our float by almost 2 times during that period of time. So, I think we've got a lot of room to grow and go up from here.
Don't you feel bad ripping the miners off with your deals priced at $2,200 gold and $4 copper?
Well, look, I think that a lot of the long-term capital providers for the mining sector have basically left. A lot of the ones that have been here for 10, 20, 30 years, they're just gone. And, the royalty sector and royalty and streaming sector has kind of grown to fill that gap. I think that the mining companies on the bigger deals have done a good job on, again, kind of structuring these transactions to be more kind of, almost more kind of debt with a gold link type of exposure and keeping some of more upside for the mining equity holders. But again, like for us buying royalties, it's a different than a stream, right? Royalties are typically uncapped in perpetuity.
Yeah, the Wheaton Precious, right? Just did what, 560 mil stream with Montage, right? Fully financed their Kone deposit. And then I modeled it. I modeled Kone with debt, with equity, with the stream. With equity, the stock price gets cut in half. With the stream, basically all the value's left over for shareholders. It's almost better than straight debt, So I see the benefits for the miners. I see the benefits for the royalties. And they financed Rio Alto, their Phoenix deposit too, like straight stream. And it's great for shareholders. It's great for the streaming company. It's great for the mining company. And those are 2 big deals, right? Like you say, the traditional guys are backing away. We can just step right in and price 2 big deals. How do you price optionality? How do you price exploration upside? I know on a general basis, I know it goes deal by deal, but what's a negotiation like that with a mining company?
Yeah. So this is something that I think is very misunderstood today within the royalty and streaming sector, because optionality, you can't fit that into an Excel model. And so it is, and it always has been a bit more of an art than a science, trying to kind of fully understand kind of what that optionality is worth. And there's certain things that we look for in regards to kind of characteristics of the operator, characteristics of the jurisdiction, the geology, and so forth that we have seen in other assets that have done very, very well, the size of the land packages and so forth. And so obviously when we're making an acquisition, you don't necessarily want to pay a big number for that optionality. That's the whole purpose of trying to buy that optionality. You want to make that acquisition and you want to pay for what's clearly defined, where you can get your shareholders their money back, and you can get your shareholders at least a reasonable return on that investment, even if it's over 5, 10, 15 years, however long the deposit is. But where you get that extra torque is where when you're looking at these assets and you're buying ones that you have a very high level of confidence that the exploration upside is there, the size of the land package is there, the operator is competent, has a good balance sheet, will continue to be able to deploy capital into this asset year after year after year. Because if you're buying optionality and it's stuck in a junior that has very little capital on their balance sheet, could have tons of optionality. But if they're not actively working the property, then the timeline to be able to crystallize that optionality goes way, way, way out and becomes way more uncertain. So there's several different factors that we look at. I can give you a quick example. One of our material assets, which is one asset that we're very excited about within our portfolio, we haven't discussed it yet, is our royalty that covers Côté and Gosselin. So Côté is now the third largest gold mine in Canada. It's projected to kick off, upwards of around 500,000 ounces of gold a year, kind of once it hits its commercial rate. And when Côté is a large deposit itself, it's got about 14 million ounces in all categories. And we saw these drill holes go in on Gosselin. Now, Gosselin was an exploration property. It was kind of a growth property. We knew that this property was here. We always kind of thought like, well, Côté is so big, Gosselin, by the time that would go into production, it's going to be 2 decades out because they have enough gold to be mined for a very long time at Côté. But they started just having some just incredible intercepts there and exploration success. And, we didn't know exactly what the extent of that discovery was going to be at that time. It was still an exploration property. It was still per resource. But, when we looked at it from a technical perspective, we said, look, there is something very significant here. Here we are sitting in a great jurisdiction with a good operator. The geology is historically very, very big in regards to the types of deposits. And so we went out and we bought this royalty pre-resource. Within 3 years, this royalty now has 7.4 million ounces on it in all categories.
You paid 5.5 mil, right?
Excuse me?
5.5 mil for the 1.35% NSR.
Yeah, US, I think it was around like 7 Canadian or so.
Okay.
And so that royalty covers all of Gosselin. It covers basically everything in between, and it covers a small part of the northern part of Côté, kind of between about 6 to 10% of the reserves of Côté. But we think Gosselin, now that we're looking at this now that we're hearing more information about the deposit and the company and their development plans, we have a very high level of confidence that Gosselin will now be integrated into the mine plan, probably around kind of 2028 timeframe. Again, kind of lining up on this big growth curve where Gosselin gets brought in potentially as kind of a super pit type of scenario, expanding the throughput of Côté. There's still IAMGOLD is still doing a number of studies on this, and they're giving guidance kind of on the integration of Côté probably will come out in 2026. So a couple of years from now, or about a year and a half from now. But this is an asset again that when you see this type of deposit, you want to get exposure to it. You want to position your shareholders in front of it. We picked it up for as you noted, around 5.5 US. To our account already, it's over 100,000 gold equivalent ounces, and it's probably going to go much, much, much higher than that. as that deposit continues to grow. It's still open. We think there's an underground component, but these are the types of royalties that elevate the valuation of the entire portfolio. When you look at Franco, they've got the Gold Strike royalty, and they've got the Detour royalty, and Royal Gold's got the Cortez royalty, and it's these very high quality, very long term type of assets that really elevate we believe, like the multiples, and it really is what drives the majors to trade at such big premiums. It's really comes down to kind of the quality of not only the asset, but the operators in the jurisdiction, that investors have a higher level of confidence to be able to kind of pay that premium for that business.
I call them Cornerstone Assets. Yeah,
That's
and
right.
all big royalties have that big Cornerstone asset that generates their free cash that they use to drive the growth for the company for the next 20, 30, 40 years. And if Cote, your Gosselin deposit, you say it's 100,000 gold. That's $270 million. You paid $6 million for it. Yeah, that's the reason why I love the royalty sector so much. And then finishing up, your NSRs on Copper World and Taka, they're a little different because most of the deals are streams off the gold production from a copper asset. You're getting straight NSR upside. That includes the copper, that includes the gold from Copper World and Taka Taka.
That's correct. That's correct. So we have a 0.42% NSR on Taka Taka and a 0.315% on Copper World. It covers the entire deposit. These royalties are non-dilutive, and in fact, the royalty that we own on Taka Taka and Copper World is actually just the other part of the royalty that Franco-Nevada doesn't own. So it's actually one royalty on Taka. Franco owns 1.08%. Taka Taka is a material growth driver for that company, which is a $30 billion business. So it just goes to show kind of the impact of what this royalty actually is. And we have the other side of that, which is 0.42, and same with Copper World. Franco holds the same royalty that we do.
Okay, okay, excellent. Anything else you want to finish up with, Brett?
Oh, look, I believe, again, like I believe that we're in the very beginning stages of a very significant commodity bull market. Metalla has the benefit today to be able to sit back and be very, very disciplined when we're looking at future growth. And it's a unique position today because the last 5-6 years, a lot of the sector was chasing cash flow. They were paying very high prices for cash flow, and now they're having a very difficult time redeploying that cash flow into future growth because there are a lot less assets to deploy capital in. And two, the balance sheets of a lot of these mining companies, with basically all-in sustaining cash margins at all-time highs, are having a lot of trouble. And so you're seeing a lot of these bigger companies invest in kind of downstream, smaller juniors and so forth. And we think having all of that growth built in, having all of that growth bought and paid for, positioning ourselves the way that we did, is going to allow us to not only scale being a mid-tier, but we think eventually a strong player within the mid-tier sector of the royalty business. And so, right now, the market hasn't fully understood what that is yet. And there's a big opportunity, I believe, in front of us to position as an investor and really capture that big growth curve that we're going to be going through over the next kind of 1, 2, 3, 4, 5 years.
Yeah, I see that too, because just your existing portfolio, your Geo Production is going to double or triple in 2026, and then you've got these big, copper assets that are, a little bit longer dated, 27, 28, already existing in your portfolio. But so, you guys can basically sit back right now. But speak to me about deals that you're looking at right now.
Yeah, so I mean, what we're trying to do right now is we're trying to continue to position our business to be able to kind of compete at the mid-tier level. So there's certain things that we're going to be looking to execute in regards to, traditional credit facilities and access to capital and so forth that will allow us to kind of compete on bigger transactions. And, still, I would say kind of competing in any type of process is probably something that we're not going to engage in, just because I feel like we will still have a bit of a disadvantage over the next probably kind of 1 to 2 years. But I think that we can use our effective and efficient process that allowed us to basically do 30 out of 32 transactions that we've completed over the last 8 years outside of a competitive process, with really just our energy focused on much larger deals, ones that can add 2, 3, 4, 5,000 geos a year, doing our best to maintain, obviously, the quality of the portfolio, and more importantly, kind of the discipline to be able to acquire these things accretively for shareholders.
I hear you. All right, Brett. Thank you very much for joining me today, and we'll talk soon.
All right, thanks, Garrett.